What do you need? When do you need it? How much will it cost? And then we balance that with the uncertainty of the future. Market performance cannot be predicted or controlled, but by using objective market information, we can come up with the most conservative strategy that you can afford. The Moneyball method does the exact same thing. We only own broad-based core equity and fixed income asset classes. Control what you can control. Take ownership of your future. Money is not stupid. Prices are information. Markets are elegant, and profits are poetic justice. Welcome back to the Moneyball Method Podcast. My name is Mark Shupe, and I'm the author of The Moneyball Method, a middle-class manifesto for objective investing. If you joined me 2 weeks ago, you may recall that I discussed the regulatory environment with regard to television sets, residential housing, and the immigration conflicts in America. In particular, with regard to television sets and residential housing, I talked about that in terms of the price mechanism. And I want to continue that conversation today. In fact, the title of my podcast is The Price Mechanism. Why are prices so important? Why do I want to continue with that thing? First of all, prices are the original information superhighway. They contain all of the knowledge and motivations of every participant up and down the supply chain, across supply networks, and across the world and in your local communities. Secondly, prices are the integrating factor between the virtues of money and the elegance of markets. That is essential. And thirdly, there's a lot of misunderstanding regarding prices, and I'd like to offer you a quote. This appeared in Forbes last July. The author was journalist John Tamny, and it was his book review of my book. And I quote, "Consider the myth of so-called pricing power. Reporters, pundits, and economists talk about it and believe it's real. But since money in circulation reflects production while attaching a money price to market goods, the rational can see that it's not real." As Shupe notes, prices are information, and new sellers will continuously enter the marketplace to capture some of that business. And I'm not here to talk about platitudes and abstractions. I want to give you some concrete examples. I want to talk to you today, begin my conversation about the quarterly and annual earnings report for McDonald's Corporation. They released their revenue and earnings numbers and growth rates for 2025 last week. And before getting into the details, I want to talk about McDonald's from the context of an article that was published 3 months ago on November 16th in the Los Angeles Times. The headline from the Los Angeles Times reads, "Fast food is losing its low-income customers. Economists call it a symptom of the stark wealth divide." Here we go again. Income inequality. Markets fail. Prices are unjust. At least that's what I infer from the headline from the LA Times. To quote part of the article, they say, talking about 2020 now, the economic recession of 2020 with regard to McDonald's. Coming at a time of flagging growth, tumbling stock, and the company's first report of a quarterly loss, the dollar menu reversed the fast food giant's bad fortune. It paved the way for 3 years of sales growth at stores open at least a year and ballooned revenue by 33%, news outlets reported at the time. So now they're going back 5 years to the Great Recession and lamenting the fact that McDonald's was having flagging growth, the stock price was tumbling, and they reported a quarterly loss. That happened throughout the U.S. economy as well as throughout the world. Hundreds or thousands or tens of thousands of businesses experienced the same thing, not to mention the small businesses that were forced out of business by the government-induced economic lockdowns. But think about that quote a little bit more. It rejects the whole notion of pricing power. Pricing power implies that companies can raise prices arbitrarily without affecting demand, without affecting revenue, without affecting profitability. It's not true. But what did happen was by lowering prices, they were able to find a way through flexibility and genius marketing to recover from the government-induced recession and achieve substantial growth with the dollar menu pricing option, a choice for consumers. To quote the LA Times again, economists say the shrinking traffic of low-income consumers is emblematic of a larger trend of Americans diverging in their spending. We're talking about 2025 now, 5 years later. With wealthier customers flexing their purchasing power and lower-income shoppers pulling back. How does one flex their purchasing power? Who are they showing off to? I don't think it works that way. And again, we're getting back to the nonsense of income inequality. And then the LA Times does the right thing. They give an example to support their claim. I'm not going to name the name of the individual here, a registered nurse at UCLA who also works a second job as a home caregiver, said she's better off than many others, and she still struggles. I can barely afford McDonald's, she said, but it's a cheaper option. A registered nurse working at UCLA went on to say this. On Monday morning, she sat at a booth at McDonald's in MacArthur Park with two others. The three beverages they ordered, 2 coffees and a soda, amounted to nearly $20. She said, pointing to the receipt, I'd rather have healthier foods, but when you're on a budget, it's difficult. She really said that, or at least the LA Times quoted her as saying that, a registered nurse at UCLA Medical Center would rather have healthier foods if she could afford it, but instead spend almost $20 on soda and coffee. There's a disconnect here. You can buy bananas and apples in quantity for less than $10 and have plenty left over for something with some protein in it, all healthy carbs, all natural food. This is not about not being able to afford McDonald's. I'd like to switch gears and talk about the quarterly earnings and the annual earnings of 2025 as reported in the Mirror Review on February 12th, a couple of days ago. And I'm quoting the author, McDonald's leadership has warned for more than a year that low-income consumers were pulling back spending. In response, the company leaned into value. CEO Chris Kempczinski said, by listening to customers and taking action, we have improved traffic and strengthened our value and affordability scores. McDonald's took action. They became flexible again with prices. It drove business, it drove revenue, and it drove profitability. I believe the revenue numbers for 2025 were like $47 billion. Profitability growth was 5%, most of that from franchise stores. 95% of McDonald's are franchises. To quote the Mirror Review further, key initiatives included relaunch of extra value meals with roughly 15% discount and promotional campaigns like the Grinch meal. I don't know what a Grinch meal is, but nonetheless, I know who the Grinch is. This was a holiday promotion and around Christmas time. To continue the quote, the McDonald's Grinch meal became a surprise hit. The company sold 50 million pairs of socks globally in a few days. 50 million pairs of Grinch socks to go along with the Grinch meal that turned out to be hugely popular, according to management. It also drove the company's highest ever single-day sales, Chief Financial Officer Ian Borden said. So I had to do a little research. I had to find out, what is a Grinch meal? How did they market this thing? And maybe it'll give us a clue as to why it worked. And I quote the Grinch meal marketing campaign from McDonald's Corporation. This is the Grinch speaking. This is my meal, and I didn't partner with McDonald's out of the goodness of my heart, said the Grinch in a handwritten note on crumpled paper from Mount Crumpet. I saw an opportunity to bring mischief to your beloved restaurant with my delicious chaos for the holidays, and I took it. So go ahead, grab my meal starting December 2nd. You're welcome for making your holidays infinitely more interesting. That is an unusual marketing message. That is brilliant. In fact, what it reminded me of something. It reminded me of something that was published in 1776 by the father of modern economics. His name is Adam Smith. His book is Wealth of Nations. And he said, it is not from the benevolence of the butcher, the brewer, or the baker that we expect our dinner, but from their regard to their own self-interest. The Grinch marketing campaign worked famously because of the trader principle. People trading value for mutual profit, expecting nothing from the either one that is charity. Getting back to the mirror review, the strongest performing segment was franchised restaurants, which generated $16.5 billion, up 5% from last year. McDonald's operates more than 95% of its restaurants under the franchise mode. This matters because franchised restaurants produce higher margins. Instead of running every store itself, McDonald's collects rent and royalties from franchisees. That reduces operating risk and stabilizes cash flow. What is this? What is in play here? What is working? It is called the price mechanism, decentralized knowledge. Individual franchisees operating stores in markets where they live, where they work, where they get recreation and entertainment, they are able to be flexible with costs, controls, and profitability in ways that central command at McDonald's headquarters or any political capital in the world could never possibly get close to. Quoting the Mirror Review, in simple terms, franchisees handle day-to-day operations. McDonald's collects fees and rent. The company earns steady income with lower costs. Now I'd like to ask you, my audience, a question. What does this have to do with the Moneyball method? And I would say that it has four things directly aligned with the Moneyball method. Number one is flexibility. McDonald's management was able to adjust prices and adjust their product lineup and adjust their marketing campaigns to the current economic trends of times. And in terms of the Moneyball method, I call it flexibility. You have the ability to adjust your cash flow and investment strategy with changing circumstances and in harmony with each other. It is the only system, the only method that integrates the cash flow strategy with the investment strategy decision. The second thing that we have in common with McDonald's management is efficiency. We hire low-cost, high correlation managers in order to manage individual sectors of the market that we want to own. In other words, we franchise out the day-to-day operations of picking stocks and bonds, so long as they correlate perfectly to the asset classes that we want to own. Which brings up number three, reliable data. McDonald's needs and relies on reliable data to make these changes, to be flexible, to be effective, to be profitable, to hire people, and to increase the number of employment opportunities for McDonald's workers. We use reliable data as well. Your rationally defined goals. What do you need? When do you need it? How much will it cost? And then we balance that with the uncertainty of the future. Market performance cannot be predicted or controlled, but by using objective market information, we can come up with the most conservative strategy that you can afford and have dry powder in the case of a market meltdown. Which brings up the fourth part of the Moneyball method that's aligned with McDonald's Corporation, and that is your funding status. Your life as the investor is the forward-looking performance benchmark. Same with McDonald's. Revenue, costs, profitability. And I would like to turn to the McDonald's Purpose and Impact Report. According to the 2024-2025 report, there were 43,477 McDonald's restaurants at the end of 2024, 95% were franchised. They had 150,000 company employees worldwide, 70% of them based outside of the United States. They went on to say, to talk about their marketing. We maximize our marketing. We stay connected to what our customers love about us and bring that emotion to our creative. That is the Moneyball method. You, as your own client, your own investor, must stay connected to the values and aspirations to give you emotional satisfaction. The second aspect, commit to the core. Our core menu remains our competitive advantage and a strength that you are capitalizing on to drive long-term growth. The Moneyball method does the exact same thing. We only own broad-based core equity and fixed income asset classes. Lastly, McDonald's says they are doubling down on the 4Ds: digital, delivery, drive-through, and development. We will continue to expand our loyalty program to power personalized experiences while getting closer to our customers by accelerating the development of new locations. As the author of the Moneyball Method, I want my readers, clients, and advisors to get closer to their goals and aspirations and use digital data to help make cash flow and investment strategy decisions. Why? Because it's objective, it's efficient, it is elegant. It incorporates the price mechanism, which is poetic justice. Which brings me to the second last portion of my talk today, and that is, how do we do it? What is the documentation? How do we memorialize the cash flow and investment strategy decision in a way that is understandable and can be implemented with relative ease? I call it the investment policy statement. It is in chapter 12 of my book. It is broken down into 11 parts. I'll go through them very quickly here. Number one is the introduction. What is the purpose of this investment policy statement? Number two, your personal information, dates of birth, retirement age, family obligations, anything that is pertinent to your particular situation that an estate planning attorney might want to know or your CPA might want to know that is relevant to the investment strategy decision. Third is your balance sheet. What do you own? What are the financial resources by tax category? What are the illiquid resources, such as real estate or closely held business interests? Fourth, this is huge. What are your cash flow expectations? What is the dollars of future wealth that we can reasonably commit to as being the performance benchmark when we calculate your funding status? Fifth is the fact and values matrix. How do these different goals and aspirations, age and life expectancy, financial resources and tax status, family obligations, health and other circumstances, how do we balance all of those with risk exposure? Which brings us to the uncertainty of the future, potential range of returns for each asset class that we are going to consider. That's important because 99% of the industry uses range of return assumptions that do not correlate to the historical data, at least not the most reliable long-term data. A lot of it is forward-looking, a lot of it is subjective, a lot of it is overly conservative, and a lot of it is unreliable. What are we relying on when we do those simulations and try to calculate your comfort zone, your funding status? Or seventh is the efficient frontier. What is the proper balance between risk and reward? Eighth is the asset allocation strategy itself. What is the recommended strategy and how are we going to implement it? What money managers, what ETFs, what mutual funds, what separately managed accounts are we going to use that correlate almost perfectly to the asset classes that we modeled when we did the simulations to arrive at the asset allocation strategy? Which brings us to the Monte Carlo summary. What is your funding status? What is the likelihood of meeting or exceeding your future cash flow expectations? 10th is the Monte Carlo asset spread. That brings us to risk capacity. What could go wrong? By how much and when? And what is the likelihood? We're going to know that in advance. Nobody else does that. Lastly is the investment policy statement, signature page, where you and your advisor, if you're engaged with an advisor, would sign off on this agreement. It's not a contractual obligation on anyone, but it is an understanding of what you are doing and why. Well, I want to now finish up talking about digital. Back to the Mirror Review report. Beyond pure financials, McDonald's 2025 results reflect the impact of digital transformation. The company reported more than 150 million 90-day active loyalty users over 60 markets, 150 million users on their app, on their smartphone. To quote the article, this number is important for two reasons. Loyalty users tend to visit more often. App users usually spend more per order. These are people spending their hard-earned money on something that they need, want, and enjoy. Digital ordering, app promotions, and personalized offers improve average check size and repeat visits. That supports sales growth without relying on price increases. Think about that. They don't need to rely on price increases to grow the business and increase profitability. In plain terms, digital keeps customers coming back. That is the opposite of pricing power. That is delivering value for value. But there's a lot of people that are going to disagree with that kind of infrastructure being employed by a large corporation that has a huge global market. And I want to quote an individual that I had contact with on LinkedIn 3 days ago about this very subject. And she was very critical of data being used for this purpose. And I quote this individual: that layer standardizes incentives, data flows, and revenue models in ways that systematically privilege engagement and volume over trust and outcome quality. The failure mode I'm pointing to is infrastructure level. Think about that. A lot of gibberish, a lot of polysyllabic words designed to impress. Systematically privilege engagement. Like being engaged with your vendor is a bad thing, whether it's digital or face-to-face. As if we want to go back to the barter system from the Middle Ages, which is really the point. Volume over trust and outcome quality. How is it possible to achieve volume without trust and outcome quality? This implies that the customers are herd animals and that money is stupid, and try to convince somebody in this postmodern anti-reason world that the volume has everything to do with trust and outcome quality. The failure mode I'm pointing to is infrastructure level. This is just anti-private sector, large successful corporation rhetoric, propaganda, dogma. And it is precisely the kind of thinking that I am trying to reverse with the Moneyball method. Control what you can control. Take ownership of your future. Money is not stupid. Prices are information. Markets are elegant, and profits are poetic justice. I hope you enjoyed this podcast today. Thank you for joining me, and I look forward to seeing you next week.